Now, moving forward, we have seen how the liability is calculated. Let's quickly understand how it is reconciled in the financial statements under IS 90. This table shows the liability reconciliation for the period ending 31st December 2024. Present value of obligation at the beginning of the period is the starting point, which represents the actuarial estimate of the company's liability as at 31st December 2023. Now, throughout the period, this liability changes due to several factors. First being the current service cost, which reflects the cost of the additional benefits earned by the employees as they complete another year of service. It is recognized as an expense in the income statement. Second being the interest cost. Now, since EOSB is a long-term liability, it grows over time due to the passage of time. This increase is recognized as an interest expense, which is calculated using the discount rate at the start of the period. Third comes the actuarial gains or losses or actuarial remeasurement. Now, these arise due to change in assumptions or unexpected deviations in actual experience and what was recognized. They are recognized in the other comprehensive income as mentioned from the highlighted section here. Now, the key factors of the actuarial gains and losses are actuarial gains and losses due to change in demographic assumption. These are the changes. They take into factor like employee turnover or mortality rates. Any change in the mortality rate or the employee turnover during the period. We have assumed that there is no change in the demographic assumption in our previous example, hence it is 0 here. Then actuarial gains and loss due to change in financial assumption takes into consideration the changes in the discount rate or salary growth rate assumption, which can impact the liability. Third is the experience variance, which is the difference between the actual events and what was previously assumed. Next comes the past service cost, which occurs when there is a change in plan benefits, either an enhancement or reduction, which impacts the liability immediately. Here we see that there is no past service cost in this example. Then comes the benefit payouts. Any EOSB benefit payout that you have done during the year will be captured here. After considering all these factors, we arrive at the closing present value of obligation, which represents the company's updated liability as at 31st December 2024. Now, this reconciliation ensures all movement in EOSB obligations are transparently accounted for, helping the stakeholders understand how assumptions, costs, and payment impact the company's financials. Moving on, let's understand the reconciliation of plan assets also. Now, this is the reconciliation of plan assets as per IS 19. First, you can see we have captured fair value of plan assets as at the beginning, followed by investment income, contribution made to the plan assets, any benefit payouts, if any, then return on plan assets, excluding amount recognized in net interest income, and ultimately fair value of plan asset as at the end of the period. In UAE and in Saudi Arabia, we do understand that most of the EOSP schemes are unfunded. So you must not be having any EOSP trust to fund the scheme. So it will be 0 in most of the Saudi schemes. However, as a disclosure requirement, we have to show them under the IS 90. Next, we have also shown you the split of expenses in income statement and other comprehensive income. Let's delve into these details also. Now here we have breakdown the expenses into income statement, the first table, and the second table shows the expenses recognized under the other comprehensive income. Like we have explained you in the past, in the previous slide, in the income statement, current service cost, past service cost, and net interest income lies, which is making the total expense recognized in the income statement. In the other comprehensive income lies your actuarial gains and losses, which is Actuarial gains and losses due to change in demographic assumptions, then actuarial gains and losses due to change in financial assumptions, due to experience variance, and return on plan assets, which excludes the amount recognized in net interest expense above. This will comprise the components of defined benefit cost recognized in other comprehensive income. Now I will request Puneet to take it further and explain us the actuarial valuation further and the recent trends in the market.
Thank you so much, Arzu, for sharing your thoughts on the actual valuation process, valuation methodology, and the valuation results. Now, when we talk about the actual valuations, the general focus is on the final liability number. But there is definitely more than just the liability number. So, here in this slide, we will talk about the key aspects of actual outputs that go beyond just the liability figure. The first one is the actual report in itself. So, one must definitely review the key data, assumptions, the benefit structure considered and disclosed in the report to ensure that the calculations are done on the reliable and the accurate information. Also, the validation of the liability figure is important to check if they align with the expectations or not. The second aspect is the employer's liability. The employer level results gives great confidence as it provide more transparency in the valuation results. Employer level results also help in analyzing the transfer in out liabilities when the employees transfer from one entity to another entity within a group. The third one is the comparison of the actual liability to the accrued liability. And it is a great way to check the actual liability and see whether it makes sense or not. We can trace it and compare it to the year on year basis to ensure that the ratio of actual liability to the accrued liability is consistent and the valuations are accurately performed. In case we see a large deviations in the ratios of actual liability to accrued liability from the previous year, then the reasoning for the same could be checked. And the last one, we have the experience variance and the sensitivity analysis in the report. So the experience variance help us to understand how accurate our initial assumptions were. And we can check whether the actual experience significantly deviate from what we expected or not. Lastly, the sensitivity analysis allow us to see the impact of change in the key assumptions on the actual liability. So moving to the next slide, the actual valuations involve multiple stakeholders. Here, we will look at the role of that each stakeholder can play in the successful enablement of the actual valuations. Now, each of them play an important and distinct role in the actual financial reporting, compliances, and the liability management. So, in this slide, we have summarized the role of each stakeholder on the different aspects of the valuations. The first one is the data. Data is provided by the company, and actuary and auditors perform the checks on the data to ensure it is accurate, reasonable, and consistent with the previous years. The second aspect is the assumptions. The role of an actuary is to assist the company in setting up the assumptions. However, the company need to confirm and finally decide the assumptions to be considered for the valuations, and the auditor do concur on that. Third one is the valuation results. The actuary is responsible to produce the valuation results. The company and auditor rely on the results provided by the actuarial team. The fourth one is the disclosures. Actually provide the valuation reports to the company, which include all the necessary disclosure items. The role of company is to disclose the same in their financial accounts or the annual reports, and the auditor concord the same. Last one is the liability management. So actuaries assess the companies in managing the liability under the different scenarios through modeling and analysis, while the companies make the final decision based on this information, considering their objective, their acceptable level of risk, business plans, etc. So this is primarily the role of each stakeholder in the actual valuation process. Now, we will look at the recent market trends which have occurred and impact the actual valuation results. So, if we look at this slide, we will see the government bond yields across all the terms has been increased as on December 2024 if we compare it with the bond yield as on December 2023. So this is the trend of bond yields for KSA government bonds. We will observe in this chart that the increase is largest at the higher duration bond, that is the increase is up to 95 basis point for 18-year government bond, whereas the increase is around 75 basis point for a medium term government bond, say a 5-year government bond. Now, if we particularly look at a 10-year government bond, which is usually highly traded, and generally most of the organizations have an average duration of around 10 years, so the increase for a 10-year bond term is around 95 basis point. It means that the increase in bond yield is expected to create a fall in the actual liability. The quantum of fall in the liability will depend primarily on the duration of liability of individual schemes. When I say duration of liability, it means the average remaining working life of employees weighted by the liabilities, which also incorporates the actuarial assumptions impact, that is, the attrition rate and the mortality rate. If the scheme had a practice of adopting a mutual compatible financial assumptions, as we discussed in the previous slides, that is, ensuring the consistent movement between the discount rate and the salary growth rate assumption, provided that the salary growth rate actually reflects the realistic picture. In such schemes, we may not experience any major impact. Also, if the scheme have already adopted the asset liability matching investment strategy, the rise or fall in liabilities will also be offset against the similar level of rise or fall in the market value of plan assets. So, the impact of change in interest rates may not actually hit the benefit schemes. Moving to the next slide, the trend of yield on UAE government bond yields. Here again, we will see that the government bond yields across all the terms have been increased as on December 2024 if we compare it with the bond yield as on December 2023. Again, the increase is largest at the higher duration bonds, and the increase is up to 75 basis point for a 20-year government bond yield. So after looking at the trend of the government bond yields for KSA and UAE, we will now look at the common audit queries. that we generally receive from the management as well as the auditors after the submission of actual valuation reports. Well, I believe we have covered a lot of queries mentioned here as a part of valuation process, which we discussed. So we are not going into much of the detail of each of the queries again. And as we promised during the webinar promotion, in the next slide, we have the snapshot of the audit checklist. This audit checklist is for both auditors as well as the management, and I believe both will find it useful when reviewing the actual valuation reports. The checklist contains all the essential checks related to the data, assumptions, and how to validate the actual valuation results.